is Bob Cunningham, and I am the Federal Tax Advisor here at TaxSlayer's Pro Support Division. My background is in accounting and law, and I've been with TaxSlayer now for 10 years. But prior to that, I've been working in this industry since 1987. So, I've got a lot of years with this company and with this industry. Today, I kind of want to talk about the 2023 tax law changes. This year we're not going through as dramatic of changes, but we do have things that are new. I want to cover the new forms, what things are happening with the forms. There's not a lot of change on the forms, which is good. Since the last couple of years, we've had a lot of changes in the 1040 and each of the schedules. Then we want to review some of the tax changes for this year, talk about some new provisions, and I'm also going to talk about some things that are going to go away. We're at that point now with a lot of that COVID relief. It's pretty much all gone, and this is the ending of it. And then the last thing I want to do is talk about the 1099-K reporting requirements. Now, recently the IRS did delay the enforcement of the changes in the thresholds for a couple of years, and I just want to go over what the rule will be this year and then the transition period. So first, let's get into the forms themselves, the 1040 and the 3 schedules. As I already said, that since 2017, they've been changing this form quite dramatically. But this year, there are no significant changes. The only change to the 1040 itself is we now have a fiscal year space that we'll have a box that we can check. That's been restored. It used to be on the form, but it was removed, but now it's back. The only thing else that's changed is they've got the filing status checkbox. They moved it from above the heading information to below it. And the last thing is they've just deleted the language regarding gifts out of the digital asset question. The reason they've done that is it really had little impact on anything, because if you gift a digital asset, that would be more of a gift tax return issue or something that would affect basis in that respect. So the next thing is we want to talk about the schedules. Schedule 1, there is no change over last year. So this is good. And the same thing with Schedule 2. Those 2 schedules are going to look exactly like they did last year. There's no new lines, no new reporting requirements on those schedules. The next thing is Schedule 3. Now, Schedule 3 is where we report credits, additional credits and payments. Now, these would be refundable credits and payments. And over here, we do have some changes to the credits because we've got new changes with the residential energy credits, and we'll talk about that in a moment. We've got a new credit that is available for these electric vehicles, these efficient, those vehicles, for used vehicles. And then the last thing is there is a new section in the payments section dealing with these elective payment amounts that folks can make off of Form 3800. These are all general business credits. And now, instead of just carrying them over with certain credits, you can make an election to take it as a payment or basically a refundable credit. So let's move into what are some of the changes this year. Well, the first thing that's really going to be an impact, I think people will notice, are going to be the CPI adjustments. And we're not going to cover each one of those adjustments, but I do want to highlight a few things. The most important thing about the CPI adjustments this year is the period that we're going to be working off of is the October 1st, 2021 period through September 30, 2022. That is when inflation in this country was at its peak. And as a result, the adjustment amount is 7.1%. This means that all of the things that got adjusted by that amount. This is the largest adjustment in decades. And next year, because they follow, the adjustment period would have been October 1, 2022 through September 30, 2023. The inflation rate was 5.4% for that period. As a result, we're going to see those types of increases next year on these items that get affected by the CPI adjustment. So the first thing, though, what does this mean for tax brackets? Because this is where we're going to see it initially. Now, for taxpayers, if you're in the lower tax brackets, the 10% or 12% bracket, and your income, year over year is still in those brackets, you're really not going to see much of a difference in your tax liability. You'll see some because the standard deduction amounts have increased, and but the threshold amount, we're still starting off at the same point, and it's just that the 12% bracket will just be at a higher income level. So you won't see much there. Where we will see some change are people that are in higher tax brackets. And the reason they'll see a change in the tax liabilities that they could have is the 12% bracket has increased a fair amount. And as a result, the next bracket is 22%. Well, that means that some folks, if you're in that 22% tax bracket, you're going to have more of your income taxed at 12% than you did last year. And that's going to show that you're going to pay an amount of tax that's going to be noticeably smaller than it was year over year. Now, as the brackets go up, this effect will be cumulative. So that's where you're going to see it. Now, will people get bigger refunds? Probably not, because if they're W-2 type employees, they're still going to have had their taxes withheld at a lower rate because payroll software will probably make that adjustment based on the withholding amounts would be lower at the start of the new year. The next thing we're going to see is we have a lot of our clients that do get the earned income tax credit. And of course, the maximum amounts of the earned income tax credits were adjusted up by that 7.1%, 7.3%. Now, where you're also going to see is the investment income limitation. It continues to get higher. And where this can help folks are particularly people that have S corporations, because some folks do not understand that S corporation ordinary income is considered investment income, and it can be applied against this investment income limitation. All right, the next thing that we will see, a fair amount of folks that will benefit by this is the child tax credit. Now, the top number, the non-refundable top number of $2,000 does not adjust. But the additional child tax credit, the refundable amount, does adjust. And this year, it will go up to $1,600. It was $1,500 last year, and it was $1,400 for many years before that. But it's going to go to $1,600. And based again on the inflation that we've experienced next year, it will go to $1,700. The next change that we're going to see regarding the child tax credit this year is going to involve people that live in Puerto Rico. Now, in Puerto Rico, they were limited on their ability to collect the child tax credit, the additional child tax credit. They had to have 3 or more children, and they had to have self-employment income. Well, that 3 or more children requirement has been eliminated a couple of years ago. And as a result, residents of Puerto Rico can claim the additional child tax credit. In order to do so, they have to file the 1040 SS, and previously they would file the 1040 PR. Well, the 1040 PR has been retired, but in its place, they've created a 1040 SS with a Spanish edition. And that really was the only difference between the two forms. The 1040 PR was in Spanish, the 1040 SS was in English, and now they just are using the 1040 SS. They have a Spanish version. In order for a resident of Puerto Rico to claim the additional child tax credit, they simply has to have earned income, which is income that is subject to self-employment tax or subject to Social Security. So they can have wages in Puerto Rico, and that is subject to Social Security, even though it is not, those wages are not subject to federal income taxation on the mainland. it is subject to Social Security, and that does allow them to claim the additional child tax credit by filing Form 1040-SS. All right, let's cover some new things. What are new this year? Well, the first thing that's going to happen is, as part of COVID relief, the Inflation Reduction Act extended the premium tax credit provisions that would have expired. And so this means that in 2023, provisions that were slated to have expired have now been extended for the next 3 years. They will be in effect from 23 through 25. What this means is that when you have people whose income exceeds 400% of the federal poverty level, they'll still be able to claim a premium tax credit if their cost of health coverage, which they've acquired through the federal marketplace, does not exceed 8.5% of their household income. If it exceeds that amount, then they could get a credit. That's the maximum that they have to pay. The other provisions is that this extension enhances the credits that everyone that gets the premium tax credit will receive this year. It just basically makes the credit larger than it would have been if these provisions had not been extended. Some other new things that are happening this year are involving the early distributions from retirement plans and IRAs. Normally, when you have an early distribution from a retirement plan, you're subject to a 10% penalty. And it's very common, but people try to find exceptions to that. And there are lots of exceptions. Well, we have some new exceptions. Some of them are going to be very, very helpful for certain people. First, we have exceptions for firefighters, police officers, and certain government correctional officers, folks that work in correctional facilities, jails, etc. Those folks now can take early distributions, and a lot of these folks retire younger. They retire early based on the type of work that they do. So they're going to be able to take this money out early without having to pay the 10% penalty. The next thing is a new provision is for people that have a terminal illness. If someone has a terminal illness, something like cancer, something of that nature, and they start taking money out of their retirement account, then they will not be subject to that 10% penalty. This is going to be something that could be very helpful to people that are in a very bad situation. And then the last thing is when people to make corrective distributions, they take money out of their retirement plan because they made an excess contribution. This was a mistake, and now they can just remove the money without having to pay taxes, pay the penalty on that contribution that they shouldn't have made. Another thing that's going to happen is with required minimum distributions. Required minimum distributions, when a taxpayer fails to take one, historically has been a very difficult situation. Now, historically, you were required to take a distribution once you turned 70 and a half. And you had certain time periods. You had to do it by the time your tax return was filed. In order to start taking money out. Well, they've changed the age requirement, and they did this a couple of years ago to age 72. It was no longer 70 and a half, it was age 72. And then when COVID relief occurred, they eliminated the requirement totally for that year. So we've had a group of people that are in their late 60s and early 70s, and they've been approaching these required minimum distributions, and the age has been moving on them. It's been a moving target. And so what we're going to have is, going forward, the required minimum distribution age requirement is going to be 73. And if you were born in 1960 or later, then it's going to be age 75. But we still have people that are going to be caught on this earlier age in these changes. And basically, if people turn 72 in 2022, then they had to take a required minimum distribution by April 15th of 2023 this year. They also would be required to take their second distribution by the end of this year, December 31st, 2023. Those are folks that turn 72 in 2022. Now, if they turn 72 this year, they're not required to take any required minimum distribution until 2024. That would be the year that they will reach 73. So this will create some confusion. So I'm just alerting folks to watch out for those taxpayers that are 73 years old in this year. Because if they were 72 and 22, that's when they had to take these required minimum distributions. The other thing that changed with required minimum distributions this year is that it previously was a very dramatic tax. It was 50% of the required minimum distribution. And in addition, the entire distribution is subject to regular taxation. So it was not uncommon for folks with these required minimum distributions to have over half of it would be taxed. Now they've changed that amount from 50% to 25%. But it goes further than that because the tax is only 10% if they take their required minimum distribution within 2 years. So this could help some of those folks that were 72 and maybe got confused. And if they didn't get all of this, as long as they get these things, the penalty would be still much lower than it once was. And then ultimately, if the penalty can be waived entirely, if the account owner can establish that they just did this, there was some reasonable error, some confusion. And again, I think we can have a good faith argument that folks would be confused by all of this transition. So we should be able to get most of these types of penalties absolved, in the near term. The next thing I want to talk about is probably not a subject that's super interesting, but that's bonus depreciation. Historically, Congress will create bonus depreciation and, for whenever they're trying to stimulate things, stimulate the economy. And in the Tax Cuts and Jobs Act, they brought it back, they created bonus depreciation, and they allow you to take 100% of the cost of that asset and write it off. Now, in order to do that, it had to be an asset that was subject to makers, the depreciation method, and it had to have a recovery period of 20 years or less. This would exclude things like real estate because rental properties, et cetera, have much longer recovery periods. Now, this provision will phase out. But we're used to it for the last several years. It's been at 100%. This year, bonus depreciation is starting to phase away. And this year, it will only be 80%. Next year, it will be reduced by another 20%, and eventually it will go away again, unless Congress chooses for some reason to extend it into the future. Another thing that is changing is meals. The last few years, we've got used to deducting 100% of meals. This was a COVID relief provision that was put in place in order to help that restaurant industry. But that provision has gone away. Now it's back to the historical amount of 50%. So what else is new this year? Well, there isn't some new tax revenues that are going to be out there, but the only one of any significance is what's known as the alternative corporate minimum tax. Now, what this requires is that C corporations, certain C corporations, are required to pay a minimum of 15% of their income that is reported to investors. This is not something that TaxSlayer will support this year in our business program. Companies made a business decision that none of our client base would use this, have to do this. And so we just decided we're not even going to support it. And here, let me explain why. In order to be subject to this, it only applies to corporations that have to report their income to investors under certain rules. And those rules basically mean that it would be a corporation that is subject to SEC regulations. This means it's a publicly traded company at some level. The next thing is that the corporation itself would have had over the last 3 years had net income that it was reporting to their investors in excess of $1 billion. Or if they were foreign-based entities, then they were reporting that their US income exceeded $100 million during that time period. Well, average that over those 3 years. The other part of it is the tax itself is 15% of the difference, what they would have been. And they still get to reduce all their credits and everything, but it's basically a minimum tax, similar to the alternative minimum tax. This is just a minimum tax that they would pay of 15%. Now, the reality is there's only 368 companies, according to the Congressional Budget Office, that would have been subject to this tax over this 3-year period. That would have even qualified because they've had that $1 billion in income each of those years. They also found that of those 368 companies, 241 of them already pay that minimum tax. And there's only 127 companies that paid less than that. And so as a result, the Congressional Budget Office estimates that there are less than 150 companies in the entire country that will be affected by this tax. And that's why TaxSlayer decided these are not folks that that will need to use our software in order to file their tax returns. And there was no reason to waste any resources or to clutter up the program with this tax, these forms that would be required. There are some new things though that we do want to cover. First ones are we have some new credits. Now, the big changes are going to be in these residential energy credits. This is going to be something that we expect to see a lot this year. Now, these credits were extended under the Inflation Reduction Act. Now, we've had these credits for several years, but these changes we now have some significantly changes to these credits. These credits were extended last year, and they were under the same terms that they have been historically. But there are some new things. The first thing is that in the property credit, and this is the credit that people get to take on their principal home, on their main home, is if they do certain energy efficient renovations or improvements to their home, they get to take a credit. The credit would be 30% of the cost of these improvements, and previously it was only 10% of the cost of those improvements. But the big change is previously there was a lifetime limit of $500. Well, it didn't take long to eat up this $500 lifetime credit limit, and this has been around for almost 20 years. So there's a lot of folks that use this credit once and it's been long exhausted for them. Now this credit has a $1,200 annual limit. So this means you can do it every year if you're making improvements to your home. Now, there are some limits on the types of things and how much you can do. If you do an audit, if you do an energy audit, you can claim the credit up to $150. Previously, it was limited to $50. You can also get a credit of up to $250 for each door that you have installed, up to a total of $500 if you install multiple doors in 1 year. There are some other limits on this. It is $600 if you install some sort of energy efficient air conditioning unit or heaters or furnaces. Same thing with windows. Windows are now $600, where previously it was $200 in the lifetime. Now you can deduct, you get a credit of up to $600 on windows. Another major change is that in addition to the $1,200 annual limit, you can get an additional $2,000 in credits if you put in these heat pumps or heat pump water heaters and biomass stoves. These are wood burning stoves. This last part is new. This is all new. And you can get that credit in addition to the $1,200 annual credit that you would get for other improvements like windows and doors. So in theory, some taxpayers will be able to claim up to $3,200 for this residential energy credit. Now, the second part of the residential energy credit is the one that we commonly see with solar panels and those types of things. And this credit is a much larger credit. This is also a non-refundable credit, just like the residential energy credit is, but it is different from the standpoint that it is allowed to be carried forward. So unlike the first credit, which you have to use in that year, the $1,200 or up to $3,200 credit, this credit you can carry forward year after year until you use it all up. And this is for these types of items. These are basically your solar systems or your wind energy type devices that people will have installed. Now, in order to claim this credit, it has to be on your residence. It has to be on your primary residence, and you can only claim it once the installation is complete. Sometimes people will sign contracts to have solar panels installed, particularly late in the year like this, and they're not completed. They're not installed until the following year. Well, in order to claim this credit, you get to claim it when the installation is complete. Same thing on a newly constructed property, people building a new home, for example, and they want to put solar panels on it, they would be able to claim that credit in the year that the installation was complete, or they take occupancy of the home, whichever is later. So, this is something, again, just to keep in mind when it comes in. Another great thing about this credit is there is no AGI limitations on it. There are no AGI limitations on these residential energy credits, and on this one in particular, because there's a lot of, these can be very large credits. When someone has solar panels installed on their roof, I mean, they can spend $30, $40, $50,000 on some of these things, and they can get the credit on all of that. And what is the credit amount? Well, it's 30%. It is 30% of the installation cost. So if someone has a $50,000 installation, they can get a 30% credit of that $50,000 or $15,000 credit. Again, these are very large numbers. Now, this credit will get smaller as we go forward, and this credit will also apply towards battery systems that people have installed. It's not uncommon for folks to have these solar panels installed, and when they have excess power that's being generated, it goes back to the power company. In some states, the power company will pay you for that. In some states, they won't, because of state laws, they're allowed to do that. In those states where they can't sell it, the power back to the power company, many of those folks will use battery systems where they'll store their own power, they'll save it up, and then they'll use their own power when the solar system, the solar or wind systems that they have are not, functioning because of weather conditions. Okay, this credit will get smaller over the next few years, and it does not apply to biomass systems, which is basically wood burning type systems. They've been moved over to the other credit. Another new credit that we're going to see, or credit that we're going to see, is dealing with clean vehicles. Now, we've had these electric vehicle credits around for a long time. They've been available since 2011. But the reality is a lot of these credits have kind of dissipated over the years because the credit was $7,500 and it was based on a quota, the number of vehicles that each manufacturer was given a quota of 200,000 vehicles, and once the vehicles were sold, the credit no longer applied. As a result, for years, we've no longer can you get a credit for a Tesla. And a lot of times, folks, people buy Teslas and they think they're going to get these credits and they weren't eligible for them because the quotas have been used up. Same thing was true of most GM models and Toyota models of these electric vehicles. This was a big problem. Well, that's changing. Going forward, these electric vehicle quotas have been eliminated. This means that these models by GM, Tesla, and Toyota are now eligible for these credits. The credit is still $7,500, but it is broken into two parts. And one part is based on on certain manufacturing criteria, and the other part is regarding the battery. Now, these vehicles all have to be assembled here in North America. This provision eliminates some electric vehicles that were manufactured and assembled in places like Korea. So you have to be mindful of whether or not the vehicle is going to qualify. The other part of this credit is there are income limitations. And so if you have a taxpayer that exceeds these income limitations, they're still not going to be eligible for the credit. And the final thing is there is limits on the price that they can charge for the vehicle. If the vehicle costs more than these amounts, the vehicle is not eligible for the credit. Now, going forward, you will be able to get this credit at the point of sale. What this means is starting next year, if you purchase one of these vehicles through the dealership, you will be able to use that credit amount as part of your down payment on the vehicle. But if they do that, they'll have to reconcile that advance payment on their tax return. But we'll deal with that next year. And any excess credit would need to be repaid. This is going to be treated much like we treat the current premium tax credit. When people get an excess amount, they have to repay it. Another new credit for this year are electric vehicle credits for used vehicles. In order to do this, the used vehicle has to be at least 2 years old, and the credit is going to be 30% of the sales price up to a maximum of $4,000. This, in order to qualify for this credit, the vehicle has to be sold through some sort of a car dealership. It can be a used car dealership, new car dealership, but it has to be sold through a car dealership. And the vehicle itself can't be sold has to be $25,000 or less. And there are income limitations on this. So if you have somebody who's a very high wage earner, they're not going to qualify for this used vehicle credit. And then the last thing, which could trip up some folks, is the credit could not be claimed previously on this vehicle. Some other taxpayer could not have claimed it on this vehicle. I said earlier that a lot of GM, Tesla, and Toyota models were no longer eligible for the credit because their quota system, they had met that years ago. Those vehicles would not have had a previous credit claim, so they would be eligible for these credit. This new credit, the last new vehicle credit, is dealing with commercial vehicles. So this would be for our businesses, our Schedule C operators, our entities, and it also covers tax-exempt entities such as nonprofits or governmental entities. And in this case, these commercial vehicles, they are eligible for a maximum credit of up to $7,500. And it's all going to be based on what type of vehicle, the weight, and whether or not it's a passenger vehicle or it's some sort of like a bus or a truck and that. If it's a bus or a truck, they could get up to $40,000 credit for that vehicle. So you could literally have certain businesses that are purchasing fleets of these vehicles, and they're going to be eligible for these credits. Now, This is a credit, and the interesting thing about this credit is it's 30% of the difference in cost of the vehicle over comparable vehicles that are powered by gas or diesel. Now, there's going to be government, um, there's going to be on the Department of Energy's site, there is going to be a place where you can go and look at the difference in price for these types of vehicles. Um, but the other interesting thing is the IRS is going to accept as a safe harbor this year that you can use $7,500 as that difference. And so you could take a credit of 30% of that $7,500, without having to go through all of that. Now there is another provision is this credit will be reduced to 15% if the vehicle also uses gas or diesel as a fuel source. This means hybrids. Hybrid vehicles could qualify for this commercial vehicle credit if for business. Now, another interesting provision is this, there is no limit on this. So as many of these vehicles, if somebody purchases a fleet, they will be able to claim it on all of those. And this credit is going to be claimed on Form 3800. But there is now a new provision regarding Form 3800 that allows people to make what is known as an elective payment election. And by making an elective payment election, the credit no longer just becomes a credit, it becomes something that can be converted into a refundable credit, basically a payment. And one of the things is this will also apply to entities that don't pay taxes. That means nonprofits and governmental entities will qualify for this. Now, it also means that Form 3800 is going to be filed on more tax returns than it currently is. Currently, it's only filed on the 1040, but now we're going to be seeing the 3800 added to certain entity returns, and we're also going to see it probably be added to nonprofit returns. So let's talk a little bit more about Form 3800. Form 3800 is undergoing a significant change. It's going to look different than it has in the past. And as I said, it's going to allow people to make these elective payment elections. And when that happens, the credit is not carried over, but it is refunded. So there are 12 of the general business credits that will qualify for this treatment. And here they are. Now, these are not credits that we commonly see, and it's not likely other than the commercial clean vehicle credit that most folks will see these credits. And the reason being is types of things that they are require large entities that would be doing these things. But here are 6 of these credits, and here are the other. Now, some of these are brand new credits, and some of them were credits that were set to expire but have been extended. In all of these cases, we're not going to go over them because, again, they're very rarely going to be used. But we are supporting these credits in our business and in our individual programs. So the next thing I want to cover is the 1099K, some information about that, because this has been a hot topic all year long. And recently, of course, the IRS has deferred what's going to occur. Now, 1099Ks have been around for quite a while, and they really started out back as a response to when small businesses started to use Amazon and eBay to sell their products. And this was a way for the government to track what was going on with those sales. And we see a lot of these things over the years. A lot of people that get triggered by this are folks like Uber drivers, etc. Now, the requirements that have always been in place since they started issuing 1099Ks is that you had to get $20,000 in gross payments and you had to have 200 transactions. As a result of those two numbers, it was not common. I mean, it really limited the amount of the volume of these things that we would see because you had to have a fair amount of money that was being transferred. Now, the American Rescue Act changed that, and it implemented a requirement that the dollar amount threshold would be lowered from $20,000 to $600, and the number of transactions was eliminated. So it didn't matter if you had one or 200, it doesn't matter as long as you have $600 in transactions. Now, this was scheduled to go into effect in 2023. And as a result of that, there's been a lot in the news, and there's been a lot. And if you go to the IRS tax forums, even in our user conference, we spent a lot of time talking about these 1099K changes. Well, the IRS on November 21st issued notice 2023-74, and they've postponed this. They've postponed this out to 2025. So for this year, the threshold is going to remain what it historically has been. It's $20,000 in gross payments and 200 transactions. This is going to be, a significant relief for much of the tax industry because, there was a lot of concern about all of this influx of all of these 1099Ks. But now it does not appear any of that is going to occur because the threshold amounts are now the historical amounts that they've always been. Now, what's going to happen, though, is there is a transition that's going to go on. Next year, in 2024, the threshold amount will be $5,000. So it'll be reduced from 20 down to $5,000. And starting next year, there will be no longer the transaction requirement. So we have this year, we're going to, continue with the historical rules. Next year, the threshold amount is going to go from $20,000 to $5,000, and then the following year it will drop down to the $600 amount that is in the American Recovery Act. So hopefully that kind of clarifies any confusion that's out there on this 1099K issue. Now, there are resources out there if you need to know more about that, and I would strongly suggest that the IRS has them. We'll also have knowledge-based articles that will cover all of this. And with all of that, I want to thank everybody for the attention, and hopefully this was helpful for all of you.